Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is July 28th, 2023. S&P 500 currently sitting at 4587. I'm David Zarling. I'm here with the part-time manager of the Atlanta Braves, Ian McMillan. It's good to be back on here with you. It's been a couple of weeks. And a few episodes ago, I don't know if it was 2 weeks or maybe 3, you talked about an important level on the New York Composite, the NYA, around 16,000. I thought it would be good to start there, unless you want to start somewhere else.
No, that works. Yeah, so we are above 16,000. Massive. You cannot look at that chart, a long-term picture of that chart, pull up the last few years and say 16,000 isn't a big level. Look how many times, maybe like 15 times?
Yeah, May 21, June 21, July 21, September 21, December 21, January 22, March 22, and then from the bottom side, so all those was a support. It broke June 22, sold off at 16,000. August 22, same with January 23. And so here we are. The NYA, I think your point is extremely valid, has moved 1% since April of 2021. Obviously, there's no way the market can go higher if you're up only 1% since since April of 2021.
Yeah, and think how many stocks that are still down. Okay, so I know you like to talk about the math, right?
Uh-huh.
The math behind what it takes to recover X percentage loss.
Oh, sure.
So let's take ARK, for example. And I say this as a grouping for a lot of these stocks that went through 70 and 80% drawdowns from, again, really early 2021 through the end of 2022.
Right.
But ARK is up 65% this year.
Still has about another 75% to go to get back to even from the drawdown.
Another 75% to go. To my point is you say, oh, well, there aren't, over 2 years, the average stock hasn't gone anywhere. Yeah, I mean, right? Because you think about your two extremes, these stocks that are still recovering from massive drawdowns. Yeah, you've got your Nvidias and your Apples and your Microsofts and things like that, and those get the headlines. And they drive major indices higher, which we know major indices are not the S&P is not the average stock. That is absolutely, I know it's a basket of 500 and that seems pretty quote unquote diversified, but really in the grand scheme of things, it's not. And I do think the NYA gives a much better picture of, okay, are we truly on our way to moving higher? And when I talk about moving higher, I'm talking about looking out months and years and moving above the 16,000 level on that index, I think is a much better indication of what stocks could do long term than some of the other things that and the things that we talk about, right? Like tech and all these other things, those are cool. But I think it's a really good confirmation event, I guess, for lack of better words.
I think that's a great way to put it. And there's two ends of the spectrum. You brought up your tech stocks that there might be 100 of those in something like the NASDAQ 100. Yes, they're approaching all-time highs, but you brought up stocks that are represented by ARKK or ARKK that had a drawdown of 80%. And I was wrong when I said 75% because it was 80% down and we're up 65. We still have plenty to go on something like ARK.
You need a 200% plus rally,
right,
to get back to all-time highs
in something like that. And then your point is just there's all sorts of stocks, not just XLK, not just QQQ, not just SPY. You look at the NYA, and the NYA has about 2,800 stocks in it, approximately.
Mhm.
So that's a little bit better representation than S&P 500. And your point is valid. Above 16,000, on average, you have 28,000 stocks breaking above important levels and just getting started. It's good info.
And the
And
Dow continued
Yeah.
its move. I think there was a little bit of a debate over this. It had like an 11-day winning streak.
Oh, okay. I'm sure all the statisticians were out on that one.
Well, yes. There was the first since 80. I think there was 11-day winning streak in 1987.
Okay. Which most people, when they think 87, wouldn't think that.
And then a 14-day winning streak in 1897.
Oh, my.
So
They went all the way back to when Chuck Dow.
1897, because there was some debate, and I would suggest, Dietrich, no surprise, right? So he's kind of the king of being able to look these things up. So there is some debate whether it's 11 or 14. He says 11, so I'm going to default to 11. And yeah, the last instance of that was summer of 87, I believe.
And so and you said the other period was like late 1800s?
18, I believe. I don't have it in front of me. I should have pulled it up before we got on here, but it was something from the week that just now popped in my head. But if you go back to, you can pull this up on TradingView. I'm pretty sure it's 1897.
1897. Okay. And then
1897. Yeah.
And so it's 11 or 14 days.
Yes.
And you have.
Anyways, it's been a price thrust. Let's just say it's been a price thrust.
Yeah, correct. If you get that much demand to move price 11 straight days in one direction.
Early 87 was the last, and that's actually a beautiful chart. If you go back to the Dow breaking above the 1930 level.
Oh, I know what you're talking about. This is January
87. Yeah.
Yep. Not that I don't want to give the impression that I was there. I'm just saying.
I hadn't been born for another.
Yeah. I was cheering for the Twinkies that year to win the World Series. So.
Did they go to the World Series?
They did. They won it in 87 and 91. And they're not even my team anymore. They're Gorkuber's team, but I did get 2 championships out of that with the Twins, and those were fun days with like Kent Herbeck and Kirby Puckett. And
did they have Chuck Knobloch back then, or was that
that more
mid-90s?
No, Knobloch would have been I would have put him on the 91 team, but I'm willing to be wrong because everybody remembers him for the yips that he had when he was with the Yankees, but maybe I'm not remember. I thought he was on that 91.
He was. It was his first year in the majors. He was a rookie that year.
That was a great team to watch from my childhood memories. But yes, January 1987, S&P breaks out of a really nice base. And from that, everybody, when they think 87, they think of the market crash, which was fine, but it rallied 42% from that point that you're talking about with that price thrust, that 11 or 14 days, however controversial you want to make it. Either way, 11 days, very 14 days, rally. And it's happening above important levels for the Dow Jones. And it's important because, yes, the Dow Jones is only 30 stocks and it's price weighted, but it is highly correlated to other indices, including the NYA. And so you have the New York Stock Exchange, NYA, above 16,000, and you have Dow Jones above important level. So the information continues to stack up for bull market behavior. That doesn't mean we don't pause.
Nothing from value line geometric.
Just running sideways yet?
Still, we got up there to 595, 600, and kind of. Right. So same highs from January 2018. That's again a pretty clear area of
So
behavior.
so think about that. From January of 2018, the average stock's average return is 0%. I'll say that again. From January of 2018, the average stock average return is 0%.
And in between there, you had a period where the average stock's average return was 138%.
Oh, because you're talking from the
From
COVID
the
low
COVID
to the
lows up to the late
I got you.
2021 highs.
Yeah,
So everywhere but nowhere.
everywhere but nowhere. And this goes back to
Power
the
of
over.
and that's the power of indices.
Yes,
Because if you told someone that, they would say you're a psychopath. Right.
right.
And then, well, my 401k's gone up, or my account, like,
Let alone some people
again, it
forget
goes
that they've
back
got
to the things that are in your 401k, that S&P fund, or that, large cap, whatever it is.
large
So
cap tech.
yeah, those have nothing to do with the average stock, the average investable stock.
It's really not a complaint. It's just saying, listen, we've had 3 20+ corrections in 5 years. We average one every 4.5. The average stock has gone nowhere for almost 5 years. Could that be information, or we need to be open-minded that if that's the case, could we move much higher, even though we've moved pretty quickly? I think it's got to be a possibility, especially if we continue to follow the leaders like the NASDAQ 100, things like Apple and Microsoft, things that are making new highs, and the other stocks seem to be following suit. The other stocks being, like, you could look at something like the NYA, and then if you look at individual stocks underneath the surface, there's plenty that are breaking out of bases.
Yes, there are.
It's a fascinating, I guess, Ian, what would change your mind? Like, so we're talking very bullish right now. We're talking about stocks can move higher from here. We're above 16,000 on the NYA, where the Dow Jones broke above an important level. The average stock has gone nowhere for 5 years, so there's room to run. What would change that?
I will start with the S&P.
Okay.
Because it's what we reference the most. It's what clients are familiar with. It's what all of our relative strength is with. It's our benchmark, right? So
For ultra growth.
right, and I get some pushback on, oh, you always use such a, like, whenever I post like relative charts of XYZ versus SPX.
Wait, is that actual ticker? I know it's not.
I don't think it is. Someone
It's
should
not.
probably buy that.
Man,
though.
how has that not been bought?
You always pick such a strong benchmark. Okay, well, no one is more aware of the S&P being a tough benchmark than I am. So we've run into this neckline. We're actually a little bit above it. I would say 4,500, 4,550. We kind of we're up in that area. The highs from March 2022. So now almost 18 months ago, we ran into this, and this was kind of the final. That was kind of the final rally before the
Sell
sell-off, if you want to call it bear market, right? That's
Yeah.
I feel like always kind of a relative question more than just slap a
in March.
20% decline. We did get a 20% decline, so we'll call it a bear market. So we're getting up in that area again where you got to go back, and this is how I think about it. The last time we got here, sellers were a little nervous, right? So do you want to buy stocks? Do you want to pay the same price you were paying late 2021, early 2022? Or I think that's how a lot of people, now that is not how you and I think about it, how a lot of people think about it. And from a behavioral standpoint, and we've seen this, momentum has started to wane. Now, that's easier said after a super strong rally.
I was going to say, how are you?
Yeah, it's much easier to see quote unquote momentum die off than had the last 2 or 3 months been a more, not such a strong move.
How are you defining momentum in this instance? Are you using RSI?
RSI is still pretty. Now, I'm not saying it's weak, but from a divergence perspective, and then when I think you look at some of the MACD, and I believe David Cox, if you're listening to this, he would agree. We're getting some divergences there. And that doesn't mean that there has been no reversal in trend. And yesterday, right? Yesterday would have been, we had some nasty candles on Thursday.
Yeah, a lot of bearish engulfing
candles. And as we got into this area, and we'll see how this plays out in the coming days and weeks, but no follow through so far as we sit here at lunchtime on Friday.
Follow through.
When we got gapped higher, and so far it's been higher the rest of the day.
So what you're describing is, I'm going to cover a couple things in case you're a new listener. Ian is saying that RSI, which is one way to measure momentum, and basically think about it, it's a calculation based off of price. And the basic idea is it's just how quickly is price moving something up or down. And it's an oscillator. So it's trapped between 0 and 100. And if you keep bumping up to the upside of the oscillator, we look at it internally here as if you are overbought using RSI, that's a good thing, but that can wane. And that also would be pretty normal for this time of year.
It would be.
And then MACD is just a smoothing mechanism for kind of the same. I don't want to get into the super weeds or nuts and bolts of MACD, but it smooths out some of that information from RSI. And that also has divergences, but divergences can happen.
Yeah. And when you get into a grind, when you get into a market that grinds higher or grinds lower, which let's say that yesterday was yesterday and it's a blip on the radar.
Oh, yeah.
It would be pretty in line. We had a strong rally, and the momentum data is going to say, okay, well, yeah, momentum's not as good as it was a month ago. Or 14 days, right? If you use RSI,
right.
14 days ago, or whatever. MACD has it's more of a moving average thing. It's not, but that does because. Well, how much? I mean, how much are we? We've been in a 10% rally the last 2 months, basically.
Right.
Early June.
Yeah, when we broke above, I can't believe I'm
first.
I can't believe I'm going to say this, but when we broke above 4180.
No way. 4180 ended up being an important level.
Yeah. So, and we've rallied about 9-10% from there.
And I'm sorry you guys had to hear about 4180 for 5 months. I'm sorry, but
I almost didn't say it.
The proof is in the put. I mean, it was an important behavioral level. It just is.
Right. It was the level where they're pushing the beach ball into the water. And once it got above there, we've had this rally. And your point is a high RSI reading isn't negative because why is overwhelming demand bad for something? But that when you get that surge in momentum, that invariably you're going to get divergences along the way, which can happen in RSI, which can happen in MACD. And really it's about
10% move, and that's at 60% annualized move.
In 1 month. In 1 month. Yeah.
And well, yeah, over 2 months. Yeah. Or I mean, 50 times 12 or 6 times 10, however you want to take it. So momentum is going to say, wow, any momentum indicator is going to say, wow, that was crazy strong move. Thus, the subsequent move, even though, unless it keeps at that same pace, which is highly unlikely, is going to say, oh, well, momentum's kind of dying off here. Well, yeah, right, because look at what we just came out of.
You're correct. We came out of, not only did we have a 25% correction using an indice, underneath the surface, you had things down 60 to 90%. And then you could make an argument from April of 22 through March of this year, you had a 20%, 19% range for a full year. I mean, you're going to see, if once we get above this level, tremendous momentum indicators and divergences. And Ian's point is, let's say we had seen follow through, and which we could still see between now and the close on Friday. We had a bearish engulfing yesterday in an environment with an RSI divergence, in an environment with a MACD divergence.
Pretty good opportunity if people wanted to take profits.
Right.
I did. I'm going to be honest. I did.
And
Full disclosure.
And that's fine because you had
Not
bearish
everything, but I
Right.
definitely trimmed.
And it's one of those things where if we were to follow through today, which we're currently not, but
We're
you
not.
don't know that yesterday. But if we were following through to the downside, you would be confirming the momentum divergence and saying, okay, we're going to take a rest here. Like obviously we've had a price thrust. We've had, you look back to January and the trifecta of momentum thrusts, but it would be perfectly normal for August and September and even a little bit of October to cool off before moving higher. We may not get that. I think we've talked internally and externally about that we may not get a pullback. And it is tremendous information that when the market had a chance to confirm momentum divergence today versus yesterday, and it's not, that's also worth paying attention to.
Even a short-term 3% correction.
Oh, for sure.
That takes you back to these highs from mid-June, 44.50 on S&P cash, and you consolidate, you absorb a lot of this. I think that's super healthy. It absolutely does not ruin any type of uptrend. Probably let some moving averages catch up so things aren't as extreme looking. And I think there's a good chance that maybe, I think we discussed this a couple weeks ago, and then we talked about 2017.
Yeah.
Just how adamant people were, the world just had to end. And that was a little bit more from not so much economic, but from political. Well, so now I would say in this environment, right, the inflation.
Hard landing versus and isn't it
Hard
interesting?
landing stop against some political, that has to go back to the inflation story. We didn't really have that in 2017. Inflation wasn't a thing.
No.
That was being talked about. I go back to what's the best way to put this in words? From looking at the severity of the headlines and how people react to them, about how bad things are and how bad things they must get soon. Of course, they're going to get even worse into the future. I kind of feel we're at that same level.
Oh, for sure.
Different reasons, but same level of animosity and angst and vitriol towards how crappy the world is.
Well, and think about the fact that people are debating hard landing versus soft landing. What they're not even arguing, there's no landing.
What if we had the landing? I mean, we did have a recession, right? Everyone keeps talking about,
they forget
there's a
about
recession coming.
Yes.
Well, we had the 2 negative quarters of GDP growth.
We did. And that was last year. And I don't know why.
Right? And recency bias tells you, right? Most people, they think recession, we've touched on this a bit. It has to feel like an 07, 09, 08, 09.
Mm-hmm.
That's what a recession, because of recency bias, that is what a recession needs to feel like.
Right.
10, 11, 12% unemployment. And that's not necessarily the case. Like the textbook definition is 2 back-to-back quarters of negative GDP growth.
Right. Which we had.
And you can go back over history. This has happened. We have had, what you want to call it, a shock recession, a blip where, it happens and life goes on. I think there's just a lot, like people want house prices to come down. People want food price. Like, I don't know what to tell you. Doesn't mean there has to be a recession.
Right.
And when you look at the stocks that are outperforming,
home builders, home construction, transports,
retail, we continue to see semiconductors yesterday on a horrible day, up over 1%. You see, consumer discretionary, market leader.
The evidence continues to stack in the opposite direction of the narrative. Like the fact that we need to keep in mind that CNBC, no fault of theirs, I'm not here to attack a mega media corporation, is talking of those type of things versus what the market is doing. We need to remember who or what defines what's in the best interest. And when charts show us who has control, and going back to the NYA or the New York Composite, being above 16,000, buyers have control, regardless of whatever the narrative is.
CNBC. Are you telling me Andrew Ross Sorkin on CNBC doesn't have a fiduciary duty?
He does not.
Oh,
He may have a conflict of interest or multiple conflicts of interest. He obviously is a very talented individual. I'm not here to argue that. Obviously, very smart and articulate and can be on TV and talk all sorts of levels of economics and markets. However, CNBC has a mandate to make sure that they generate revenue. And one of the ways they do that is by selling you razor blades, cars, and you name it with their commercials. And
they
I don't
keep
really
you engaged with fear.
Right. And I really don't care about that, because if demand outpaces supply and we have an uptrend, I need to be invested for my clients who I'm trying to operate in the best interest for. And if NYA, if the New York Composite is above important levels, if the Dow Jones is above important levels, if the S&P is above important levels, the NASDAQ 100 is above important levels, then we need to be invested for our clients. Regardless of the narrative of hard, soft, I don't care. Markets are a future discounting mechanism. You're telling me that markets don't look out 6 to 12 months on the prospects?
Look at our surprise GDP number from yesterday.
Oh, yeah. I'm sure it was surprised.
I guess there's only one Fed bank that got it right, which was Atlanta. I think like Atlanta's a little bit more optimistic than most, but go figure. Just in Q2, stocks up. We'll use the S&P. So what is that? April, May, June is Q3.
Okay.
Is that correct? Am I thinking right here?
Yeah. January, February, March, Q1. April, May, June, Q2.
Stocks up 11%. And it's baffling. It's baffling to a lot of people. And then surprise, here comes the economic data. Surprise to the upside. Again, markets are forward. It's amazing what the market can, not just on an individual basis, right? We talk about this all the time with stocks and how the selling and the supply, usually you can see it in a stock chart well before any type of major news hits the wires. Same with broad indices. It's just a more 30,000 foot view.
It's really hard. Is we live in a microwave society, right? We want our dinner ready in 90 seconds. We watch financial TV and we get really myopic. We really narrow down to the day-to-day. When trends are not day-to-day, they're the culmination, the aggregation, the ongoing day-to-day movement. As an example, yesterday's Thursday, the 27th of 2023, bearish engulfing. What that means is the price range of yesterday exceeded
the old gap and
gap and crap.
Yeah.
Gap and crap. And so you have a bearish engulfing, and when you don't confirm that, that is information. It could be an opposition of what the current entertainers and information providers of our day on TV, on the internet would cover. And so you have to be very careful being myopic and being so narrow focused that you don't see the trend that is unfolding before you. Because typically markets work where we rip higher from here. And that's when investors start to get involved. And that's when like earnings are at their best. Like, holy crap, everybody's like, it's unbelievable. Everything's unbelievable. And that's when markets start to discount. Because they're future discounting mechanisms. They don't live in the moment. They live 6, 12, 18 months in the future. They don't live today. And so there's this juxtaposition between the investor, or not all investors, at least not ours, who look at today, like, how can that stock be up today? They had negative earnings. How could that be? Versus the market that's looking out into the future. It's a really interesting dynamic between the individual investor and today and what the financial news would like to sell versus what 6, 12, 18 months in the future if we move higher. All I'm saying is don't get married to financial news. Not really a great way to do it.
Never has been.
Yeah, I would say let's use charts.
Let's use charts because if you follow the narrative so far for the first 6, soon to be 7 months, this weekend, yeah, right? The We'll get monthly charts on Monday.
Yeah, I love that.
It's been pretty doom and gloom, whether it's economically, politically, socioeconomic, just house prices. And again, like what we were just saying, inflation. Yet, outside of very extreme fat tail events, has nothing to do with your investment portfolio. It just really doesn't.
Right. 100%.
Because things are tough, or you hear things are tough, things are bad, things cost more. This is not a one-to-one relationship of, okay, now I should sell stocks. I should lessen my exposure. And we've talked about this at lunch. How much time have we talked about inflation and assets at the lunch and learns? And what inflation typically means for things like the stock market.
Right.
That's all denominated in dollars, right?
It's all denominated in dollars. And, there's books out there, like one of the most important books, and I encourage people to read it, is I think it's The Madness of Crowds. But there's wisdom in crowds until we get to points of extreme. And this goes back to that Billy Beans in the jar experiment. Ian, I don't know if you're right, where the individual guesses tend to be outliers, where when they're taking on average, they're within like 3%. And so when we look at markets and the dollars that are at play, so think of the dollars as the guesses, not the individuals, right? Because if I've got $1 billion that I'm managing, my guess matters more than the person managing 100,000. And so when the big sharks and the big whales are taking guesses and they're looking out 6, 12, 18 months, collectively, this is what impacts supply and demand. It gives us price. And so here we are in an environment where the media is focusing on hard or soft landing or earnings apocalypse, which is crazy to me.
Yeah, we're in the earnings season.
Yep. But yet the market is moving higher. The collective opinion of the dollars that are at play is what matters more. And we're pretty open with, we care more about what the price reaction to earnings is versus the earnings themselves. That's what matters. And we're not here to say, like, in 1 or 2 episodes that we have a change of tune. I'm not here saying the market moves 30% higher from here. But as long as the NYA, going back to our original point of anchor, is above 16,000, the thesis is stocks are higher.
Well, and we just talked about, right? You don't, like, we're coming off a 10%. So we had basically, we had the big run up into February. Stocks didn't go anywhere for February, March, April, May. We'll call it 4 months, all of February through all of May. And we move higher. And we could go through another 2, 3, 4 months of not going anywhere. They don't happen in a straight line. You can have great years.
People love straight lines, though, Ian.
Yeah, the market can absolutely end up 20% plus this year. But it's, those things are going to happen in a majority of the time outside of, like, we go back to a 2013 where you're just kind of cruising all year. We talk a lot here about 2017. That had a few periods where stocks didn't go anywhere for 2, 3, 4 months.
Yep.
And yet it looks great when you look at the data. You're like, wow, up, whatever it was. It was pretty sure it was a 20% plus year, 23, maybe something around there. 2013 was a bigger one. Like, wasn't 2013 like 30? I don't have the data in front of me, but
it was 2013. You had a market environment where we're in an uptrend and you have stocks move, let's call it 30%.
Yeah.
I'm not going to get into decimals, but during that you had an 8% correction. You had, and correction is the wrong term, 4% correction. These are things that happen. Like, these are normal. You had 2 4%, 1 8% on the way to 30% in 2013. That's normal market volatility. And going back to what we were saying before, we've had 20% corrections in 5 years when normally you get one in 4.5. So could we move higher from here? Absolutely. But let's not get myopic if we correct 5%. Let's say we correct back to 4,200, that 4,180 level we talked about before. So we're talking about 7% volatility in the next 2 months. Let's not forget the big picture of what's happening here, because that would be perfectly normal to have that type of correction back into those levels and then move higher in the strongest 6 months, which is November, December, and then January, February, March, April of the following year. And then we stagnate because it's an election year, or it's a part of the 2-year cycle. It's part of the whatever cycle you want to look at. We have to be open-minded on, even if we were to correct from here. And when I say correct, I just mean in the normal context of what we see in corrective markets, which is somewhere
like 5,
between
10%.
that is normal behavior. And we could see that now through September, October.
Yeah. Just know your retirement was built on 5 and 10% corrections. So chill out with if you get too high of anxiety.
Right. Like, let's not look at 3 months. Let's look at trends. And let's say we pull back into 4,180, 4,200. Man, would that be a tremendous opportunity? Most likely. Below that, not so much. But from a evidence and Bayesian process of trends and taking in the most recent information as being the most important, that would be a tremendous opportunity. But I don't even know if we get that.
Well, okay, so I'm going to segue into, you had mentioned this when we talked about it before. So on average, we get a 20% correction on average X amount of years. And we've had a lot, basically on average, one a year over the last 4 years, 5 years.
Yeah, like if you look back at market history, you get 120% correction once every 4.5 years.
That's the key language there, is on average.
On average.
One thing, and we brought this up maybe 2 years ago, but it was when it came out at the time, it was a post, and I believe, I might be mistaken, it was a post by Michael Batnick, and he talked about the Dow and how, okay, quote unquote, the Dow on average, you're going to get 7-8% a year. But he actually looked at the ranges of returns.
You never get 7, right?
Yeah, you never. The chances of you ever getting between like 6 to 9 are like, it's really not happening. It's always going to happen kind of the fatter tails. I'm not saying they all have to be the fattest tail. You're 99.5%, 3 standard deviations.
Right.
But the returns happen, annual returns, when you sit back and say what happened over the last 12 months, typically happen in the more fatter return. Both to the upside and downside. Yeah.
The amount of times that you get a 7% return is almost 0, but the average return is 7%. So think about that. And that goes back to your comment about markets don't move in straight lines. They just don't. Like, you could be up 30% a year and you have 2 8% corrections. And this is what gets investors all in a tizzy, is the 8% correction, when all you have is and this is why charts become powerful in demand, because you can see when higher highs and higher lows are happening. And this goes back to that 4180 level. If we're above 4180, which is, I believe, is 6 or 7% from here.
Yeah.
If you have that and you're above that, it's okay. It's perfectly normal. You have to have these variabilities that allow for tremendous returns in the future. That's such a great point, Ian. Like, there's no straight line in markets, and you're not involved in markets to have fun or because they are fun. You're involved in markets because you're trying to protect your purchasing power.
Yeah.
Right. As retirees. Like, when you're in 20s and 30s, like, some people get things confused and they think they need to be involved in markets because it's fun.
They saw it on TikTok.
Yeah, like they saw some on TikTok, or
well, this guy was up 400% in one day because he bought, end of week options.
He YOLO'd DTE. Like, okay, but that's not really, as you get near or in retirement, you're not involved in markets to have fun. there's no gamification with your retirement.
There
It's
to keep up with inflation, to grow your assets.
yes.
This is what I would say. I mean, retirement is definitely a game of keeping up with inflation, and equities historically are a great way to do that.
100%.
But it's right. And well, that just goes back to our comment earlier. Equities during inflationary periods, I'm telling you, they do a lot better than you think.
Yeah, correct. And it wasn't that long ago when people were talking about, oh, well, with the T-bill, I can get 5%. And that's the environments where equities seem to do well.
Which is great. You got a risk-free 5% this year. Meanwhile,
Yeah, that's great.
Stocks are up.
Multiples of that.
And the Nasdaq's up like 40%, I feel like, or something.
And so
I don't have that in front of me, but
it's this balancing act of like, I get it if you're in 20s and 30s and you want to gamify this and you think it's like just fun to like pick this stock and that stock and look what it did. And then there's all sorts of like human biases that happen where you forget the stock that you bought that dropped 60% and you remember the stock that jumped 40% and you just broke even for the year. Like there's all sorts of crazy stuff that happens in your 20s and 30s. But when you're 40s, 50s, and 60s and you're getting near and in retirement, you're not involved in
actual wealth.
Yeah, like you're not
hundreds of thousands of dollars that I need to either grow or protect.
Right. And you're not in that environment for fun. You're in that environment, like you said, to combat inflation, protect your purchasing power, because you have either a livelihood you want to live when you're in retirement.
Whatever it is.
And I don't care. Like, if you live
no matter what lifestyle you want to protect, but you're there to protect it.
Right. And if you got like health things that are going on, or you like there's a legacy thing, or you're philanthropic, you're not involved in markets as some type of game. You're involved because this is the way to outpace the degradation that happens with inflation.
Go join a senior men's softball team if you want to play games. It's not
right.
I absolutely plan on doing it. I plan on being involved in real games.
Yeah.
The market is definitely not and I would add to that, it's not a place to feel cool. It's not a place to say, look, I want to be able to say I own that.
Yeah.
Oh, I want to be able to show up at the country club or the cocktail party and say, oh yeah, I'm up 60% on XYZ.
Because I own NVIDIA.
Yeah.
That's great, but I only know that's X percent of your portfolio. Tell me about the rest. But we want to marry the things that look the best. It's interesting. We just want to highlight that markets are the most competitive arena on the planet. We're not involved with them to have fun. We're involved with them to participate in uptrends when it makes sense in order to protect our purchasing power, outpace inflation. We're not involved with them when they're in a discounting period, and they're not in a discounting period right now, especially from a thesis standpoint. If NYA is above 16,000 and the other indices remain the same. Ian, I thought this was a great episode. I think our listeners are really going to appreciate it. We didn't touch base on some of the other things in our show notes. I did want to highlight before we step away, and then I'm going to let you have the final piece after I go through who supports our podcast. But be ready we're going to wrap this up. What you want to end with. I want to let our listeners know that the weekly trend is supported by Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. Adaptive Select helps investors to access two of the most prevalent factors in markets: momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV by adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, take it away from here.
If I call, are you the one that picks up the phone if I call that number?
That wouldn't be awesome?
Wouldn't that be?
Yeah, it would be kind of like, hey, what's up?
So you're not. I don't get to talk to you.
No, unfortunately, or you.
No, I did not pick up.
Okay.
That would be
They will make sure that if they need to, they could talk to us.
absolutely.
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 So we covered a lot of ground. Great information this week. We didn't touch base on bonds. We didn't touch base on crypto. We didn't touch base on the dollar. That's okay. It's up against our time frame. Anything you want to leave our listeners with who are going to give us a high ranking and share it with their friends?
They will. I've already checked with them. They all said that they would.
Yeah.
Yeah. So bonds, clients that we got a market letter going out, believe today. So we know bonds haven't gone anywhere. Now, internally in bonds, there's some risk on, junk bonds versus treasuries, or some riskier corporate bonds versus treasuries. Some good things going there, which they point higher for a risk on environment. I don't know in general for assets.
Right.
I don't know what that means for bonds themselves. Quite like if junk bonds go down less than treasuries, it's not really a game I need to be involved in.
For sure.
Dollar, not as clean of a break. We'll see where the dollar goes. It's a pretty big factor, especially for the small caps. We'll see where this goes. I would have liked for it to stay below 101. We'll see where this turns out. It is a failed breakdown, but really not super concerning until probably 104, 105-ish.
Okay.
But
and that impacts a lot of things, but we've bumped up against the end of our time. Great episode with you, Ian. Great to be back on here with you. We appreciate all the people who listen. There's a fair amount of you. And so we ask you to give us a high ranking. We ask you to share this with others. Obviously, you're not paying to receive the opinions and not recommendations that we're giving. But if you value those, you could go ahead and share this information with others. You guys have a great week ahead.
Have a great weekend, everyone.